Welcome to the Minnesota State Retirement System Pre-Retirement Seminar. My name is David and I will be your narrator today. This section of the seminar will be about pensions. Besides Social Security, your pension will likely be one of your greatest sources of retirement income. For our purposes today, we will be referring to the MSRS General Plan since 90% of state employees are in this plan. The amount you receive from your pension in retirement is based on a formula. It's important to note that the amount you contribute to your pension does not affect how your pension benefit is calculated. We will look at the following 4 factors to determine your monthly pension benefit. The first factor in determining your pension benefit amount is called service credit. This represents the amount of time that you worked for the state and paid into the pension plan. Every month that deductions are taken, you are given a month of credit. However, if you work less than 50% time, your part-time service is prorated. You also receive credit for periods of time that you would be on a workers' compensation leave of absence. You also receive credit for a voluntary leave of absence if you purchase that period of time, and if you repay a refund. Perhaps you worked for the state of Minnesota and took a refund of that time. If you repay that refund to MSRS, we reinstate that service credit to your record. You'll notice that under current law, 5 years or more are required to be considered vested. Being vested means that you are eligible for a monthly retirement benefit. Perhaps at one point in your career, you were covered by a different Minnesota public pension plan, either TRA, Teachers Retirement Association, or PERA, Public Employees Retirement Association. You may be wondering if you will be receiving pension credit for that time. The time you earn in one of those pension systems stays with that pension plan, and you are at retirement eligible for a coordinated retirement benefit as long as you have at least 6 months within each particular public pension plan, and as long as you terminate from all plans before you apply for your pension benefit, and you must start collecting from all those plans within 1 year of each other to be eligible for that coordinated retirement benefit. This average monthly salary includes your total gross wages, but does not include any lump sum payouts at retirement, such as the lump sum for any unused sick or vacation time. Your average monthly salary also is not reduced by any contributions you might make to your Minnesota Deferred Compensation Plan or the Healthcare Savings Plan. The next thing we do to determine your monthly retirement benefit is use a multiplier to figure out how much of your salary we are going to be replacing. The benefit multiplier for the general plan is 1.7% for each year of service. As an example of how that's used, if you were to work for the state of Minnesota for 20 years and receive 20 years of pension credit, we would multiply that by 1.7, or you would receive 34% of your average monthly salary as a pension benefit. At or after your full retirement age, you would receive that benefit for the rest of your life. Instead, if you were to apply for that benefit prior to your full retirement age, you would receive a lesser benefit for the rest of your life. Your full retirement age depends on your original hire date into a job covered by a Minnesota public pension plan. For example, if you were first hired into public employment prior to July of 1989, your full retirement age would come at age 65. If you were first hired after July of 1989, your full retirement age is at age 66. If you apply for your benefits before those respective ages, you will receive a lesser benefit for the rest of your life. If you work beyond your full retirement age, you will receive a higher benefit because you will have more service credit. Let's look at an example of how this formula is used to calculate benefits. Anita has worked for the state of Minnesota for 30 years. She's retiring at age 66, so she's retiring at her full retirement age. Her average monthly salary was $5,000 per month over a 5-year period, and her multiplier is 1.7%. So she will receive 30 times 1.7, or 51% of her salary for the rest of her life. 51% of her salary turns out to be $2,550 per month. Sarah started working at the same time as Anita, but she is choosing to retire 4 years earlier. She is retiring at age 62. At that time, she will have 26 years of service. Her average monthly salary will be lower because she did not receive the same annual raises that Anita received over her final 4 years. Sarah's multiplier is the same, 1.7%, and Sarah's reduction will be 0.7445 at age 62. So if we work through the formula, Sarah will receive $1,520 per month for the rest of her life by retiring 4 years earlier. In the next example, we're going to look at Sarah receiving her benefit at age 62, like we saw in the previous slide, and we're going to take a look at Sarah's decision at age 62 to delay or defer her pension benefit until her full retirement age. So if Sarah works until age 62 but chooses to receive her pension at age 66, the formula is almost the same. She still has 26 years of service. Her high five did not change. She was no longer working. Her multiplier is still 1.7%, but that penalty or reduction is removed because she's starting her benefit at age 66. Is she receiving full retirement benefits at age 66? Yes, she is, but she's not receiving the same amount as Anita in the previous slide. Anita was eligible for $2,550 because Anita had a higher average salary. She had more time, or a total of 30 years. Keep in mind, full benefits means the full formula, not a maximum benefit. If Sarah were to continue to work beyond age 66, she would receive more. This next slide shows the different options a person has at retirement and possible survivors. So for example, every employee can choose what's called a single life benefit. It is the calculation we just worked through, and it is a monthly benefit paid for the rest of your life. If a person should pass away under this single life option, there are no monthly survivor benefits. A person might be interested in protecting a survivor, a partner, a spouse, with income if they should pass away. So there are 3 choices called joint and survivor options. The first option shown is the 100% option. Your benefit is less. By choosing the 100% option, if you should pass away, your survivor benefit is 100% of what you were receiving, or $22.38 per month. Those figures are based on an actuarial table, and it's based on assuming that both the employee and the survivor are age 66. If the survivor is younger, the cost or reduction for that 100% option will be greater. If the survivor is older, then the cost will be less. The last column shown there is called bounce back. If you choose the 100% option and your survivor were to pass away first, we no longer need to provide that survivor with income, and so the employee bounces back up to that single life amount, and they receive that for the rest of their life. The next option shown is the 75% option. Under that choice, the cost isn't as great. The employee or retiree receives $23.08 per month in this example, but if that person should pass away, the survivor benefit is 75% of that, or $17.31 per month. Again, in this example, there is a bounce back provision. If the survivor dies first, the employee or retiree bounces back up to $25.50 per month. In the last option under joint and survivor, called the 50% option, the cost is not quite as great. The monthly benefit is $23.84. If that retiree should pass away, the survivor benefit is only half, or 50% of that amount. Again, the bounce back provision applies if the survivor should pass away first. Down at the bottom is shown an option called Life Income 15 Years Certain. Under this selection, the retiree's benefit is reduced by an amount based on their age. And if that retiree should pass away in less than 15 years, we make a payment to the survivor for the remainder of 15 years. So for example, under that selection, if the retiree lives for 10 years and passes away, we pay the survivor for 5, and then we end the payments. There are no bounce back provisions under this selection. If the employee lives for 16 years, we continue to pay them. or 20. It's a life income benefit, but the survivor benefit is limited to only the first 15 years after the employee retires. And so to review, the joint and survivor options are for life. It's life income for the retiree, and if the employee or retiree passes away, the survivor benefit is for their lifetime. Other things to keep in mind with these options, they are irrevocable. Once the benefits are being paid out, these options cannot be changed. There is no option to add a person later. There are no life events. There's no way to remove a person or switch to a different survivor option. Also note that the survivor does not have to be a spouse. You can name anybody you would like as your survivor, but keep in mind their age will dictate the cost. A younger survivor will equal a smaller benefit for you and that survivor. If you are choosing a non-spouse survivor who is between 10 and 19 years younger than you, you may only select the 75 or 50% option. If you are choosing a non-spouse survivor who is more than 19 years younger than you, you may only select the 50% option. It's also important to note that this is a valuable benefit. We'll take a look at the last column. Anita receiving her monthly pension at 66 after having paid in $67,000 of contributions to MSRS will be eligible for a monthly benefit of $25.50. If she receives that benefit until age 90, she will receive approximately $876,000 from MSRS. The reason we're able to do that is over her career, we invested her contributions and the employer contributions to grow that money to be able to pay her a lifetime benefit. When you receive your pension benefit, you will be receiving taxable income. We can withhold both federal and state income tax for Minnesota only from your pension benefit, and you may adjust that tax withholding at any time. You will receive a 1099-R showing the amount you were paid during the previous year and the amount of taxes that were withheld. Once you are retired, your monthly benefit is also expected to increase. Your first increase from MSRS will be prorated based on when you retired during the year. Increases are paid in January, and once you've been retired for at least 18 months, you will receive the full increase each year after that. The current benefit increase is 1% of your total gross pension. Some people might choose to work after they retire. This information applies only to those who return to work to a position that would have been eligible to pay into MSRS. The first thing that you'll need to do if you return to an MSRS eligible position is notify MSRS of your reemployment. A 30-day break in service is required from your retirement date to returning to this new employment. Note that no retirement deductions are taken. Once you've started receiving your pension, you are not eligible to continue paying into your pension. And if you are under your Social Security full retirement age, which is somewhere between age 65 and 67 based on your birth year, we will suspend your benefits if you exceed the Social Security earnings limit. If you exceed that total gross salary in a particular calendar year, we will suspend your benefits for the rest of the year. We restart your pension the January 1st of the following year, or when you end that employment, we will pay you back those suspended pension benefits. Returning to employment after retirement might also affect your eligibility to access your Minnesota Deferred Comp Plan and your Healthcare Savings Plan accounts. Sometimes an employee will pass away before retirement, and there are death benefits. If there is a surviving spouse, the surviving spouse is eligible for the 100% joint and survivor benefit as if the employee had retired instead of passed away, and as if they had chosen their spouse as the 100% joint and survivor. Instead of that, the surviving spouse may elect a monthly payment for a fixed period for 10, 15, or 20 years, each with different amounts, or the surviving spouse may elect a lump sum refund of just the employee contributions that were paid into the plan plus 3% interest. If an employee passes away and does not have a surviving spouse, minor child benefits may be payable, or a lump sum refund of the employee contributions plus interest is paid to the employee's beneficiaries or their estate. And finally, some steps you can take now. You can review your annual statement. You will receive those around your birth month if you are vested in MSRS. You can log into your account online and review your pension calculation. And you can schedule an appointment with an MSRS representative and review your pension benefits. You'll also want to take a look at the impact of retiring early before your full retirement age to see what effect it might have on your monthly benefit. And finally, we'd like to leave you with a retirement timetable. As you're approaching retirement, keep in mind these time frames which may be helpful. When you apply for your MSRS pension, we will need the following documentation: an application, a direct deposit form, a photocopy of your birth record, a photocopy of your survivor's birth record, and if you have ever been divorced, we will need to see a certified copy of your divorce decree. After retirement, it may take up to 6 weeks for you to receive your first payment. However, that first payment will be retroactive to your last day of work, so that first payment may be up to 2 months worth of retirement pay. Every month after that, you will receive your pension payment the first week of the month. In December, we will send you a letter letting you know if you are eligible for a post-retirement increase. In January, we will send you a 1099-R so that you can do your taxes. Please contact these agencies for more information. If you would like to schedule a phone or Zoom appointment with an MSRS retirement counselor, please visit our website and select Contact Us. You would then complete the appointment request form. Downloading Zoom is not required. You may join a Zoom meeting by joining through your browser. Thank you for attending today's session.